Dan menjelang mesyuarat pemimpin Bank Pusat Global bersama The Fed pada minggu ini, kita ingin membincangkan apakah jangkaan bayangan yang akan diberikan bersama dengan Ketua Pakar Ekonomi Juwai IQI Shan Saeed. Shan, what can transpire out of the Jackson Hole meeting this week? Can we expect bond tapering commencement or formal date at least, or Fed's partial withdrawal from the bond market?
Rizal, in my opinion, if you analyze the Fed minutes, it doesn't point to immediate tightening because of three reasons: because of market, delta, and growth. If you see, global and U.S. stock market reacted negatively to last FOMC meeting, which stated that Fed tapering of asset purchases could start by year-end or early next year. It did not go down very well with the markets. Plus, Jerome Powell said that we still have very much with us the COVID situation, and that casts shadow on economic activity. Secondly, Delta variant can delay or it can impede the global recovery. Right now, 40% of the cases in U.S. are coming from Florida and Texas, where people have not even vaccinated. So that is a huge impediment for growth. Thirdly, data has really disappointed in the economy because consumer spending has gone down in July and even in August. And the savings that people have been talking about, that U.S. consumers are sitting on $2.7 trillion, those savings have gone. The $900 billion in Trump's administration in December and $1.9 trillion in March this year. So those savings have gone. So I don't see the tapering taking place this year. Maybe end of next year. That looks more pragmatic and more reasonable, taking into account the market volatility and uncertainty.
And as you said, markets have been very uneasy, and investors are nervous since the July meeting. We've seen equities in chaos, and uncertainty is certainly getting higher in the market. What are investors thinking of the risk factors and Fed's move? Do you think the Fed could be panicking?
Absolutely, Rizal, you are spot on. The markets have been uneasy. They have been real bedlam in the economy. As I shared with you in your last program, 2 months back, I foresee four risks happening in the markets, and some of those risks are already in front of us. The number one risk is the systematic risk. What is systematic risk? The hike in inflation and hike in interest rate. It looks very much on the cards maybe next year. Second risk is the sovereign bond risk. $16.3 trillion worth of global sovereign bonds are trading in negative. Free markets don't work in negative interest rates. The third, there have been a liquidity crisis. Starting from September 2009, if you recall, there was a crisis in the repo market, and Fed had to inject $7 trillion from September 2019 to January 2020. And again, June this year, we have seen on 30th June, Fed injected $1.1 trillion in the reverse repo market. So obviously, the money market is having some challenging time with liquidity issues. The fourth risk is the equity valuation risk. We have seen as of 14th August, the equity market cap is around $98 trillion. Telecom is $1.74 trillion. Food is $5 trillion. Cryptos with no fundamentals have touched almost $2 trillion. So we expect the risks are getting higher, and investors, they don't know how to hedge themselves against these uncertainties and against this pandemonium that is passing with every hour. So I think the real growth should bring abundance, not shortages. And these risk factors will continue to go up as we move into next 3 or 4 quarters.
But you know, Janet Yellen and Powell and all the top-notch industry gurus said inflation is transitory and will go away. You went against these pundits, and it seemed you made the right call about the inflation outlook. What can we expect about the price inflation outlook in the last quarter of this year? Yesterday, Wall Street Journal story on the front page depicts the inflation hike challenges the Fed chair.
Rizal, if you recall, on 7th May 2021, Financial Times ran an article. It says, when it comes to inflation, how much fortitude does Fed have? It clearly depicts that Fed does not have a strategy how to control this inflation. And as you rightly said, in February, the inflation was trading at 2.6%. And as of June and July, the inflation has gone up to 5.4%. This inflation is not temporary or transitory, I have been saying. Plus, there are two factors that Fed has failed to recognize, that when you have inflation, the Baltic Dry Index is going up, it's not going down. A capsized ship can cost you $50,000 US. So I think shipping costs are going vertical. It clearly reflects that inflation is a serious matter, and Fed and Janet Yellen have been, misreading the market. So when you misread the market, obviously the market gets edgy. And inflation surge seems all too likely, but unfortunately a supine Fed doesn't believe in.
Singaporean bank DBS on the 12th of August shared that ringgit Malaysia would hit 4.4 ringgit to a dollar. You said at the start of the year around 3.67 to about 4.10. Do you still hold that position of about 3.67 to about 4.10?
Yes, Rizal, at Juwai IQI, we always make one call. We don't revise our forecast. We continue to believe that confidence in Malaysian ringgit is going to bounce back. The premise is very simple. Higher oil prices are again in the market. US dollar will have tail end risk. In the last 48 hours, US dollar has lost 0.5% of its value against basket of currencies, including pound sterling, euro, Japanese yen, and Swiss franc. And above all, I would say in the last 17, 18 months, ever since this pandemic started and the lockdown started from 18th March onwards last year, Bank Negara has made some tactical and strategic moves, and those moves have really paid off. So I think I give full credit to Bank Negara for maintaining structural stability despite we are having fragilities in the global economy, despite of this pandemic, and despite of domestic hiccups. Ringgit has shown its stability in the market. So I still stick to my view that we shared at the start of the year, 3.67 and 4.10 by the 31st December 2021.
You also made another forecast here, Shan. The BNM and the Ministry of Finance agreed with your GDP forecast for 2021. Growth would fall between 3 to about 4%, similar to what you've shared in earlier this year. However, one rating agency said that growth for this year could be around 0% for Malaysia. What do you make of this?
Rizal, when we look at the economy, we look at the global macroeconomy very, very closely. We analyze various factors. So when you're making a forecast, you have to consider many variables into account. You can't just make a sweeping statement out of thin air that Malaysia's GDP will be 0%. We still believe at Juwai IQI that macroeconomic stability will return. The new Prime Minister has already made it clear that economic recovery is very much on the card, and we are hoping, and many industry experts are hoping, by September end, economy will be open up. Trade and export volumes are still going higher despite domestic hiccups, despite global economic fragilities and uncertainties. Malaysia as a trading hub has shown her resilience, and we still believe that 3 to 4% GDP growth is very pragmatic. As far as rating agencies are concerned, rating agencies have been wrong about Malaysia since 2013, so they have become irrelevant. It is a matter of how strong is your market intelligence report and who is calling the shots in the market.